Hello guys, my name is Manny Resto and I'm the head trader for RigFX. First of all, I want to thank you for joining our group and for watching this video. If you're new to the Forex market, I would strongly recommend that you watch this video first because it will give you a lot of basic information that will help you understand this market better. I decided to create this group because in today's environment, you need to have different investment alternatives. There are different ways to participate in the Forex market. You can participate either by trading yourself or you can have experienced Forex traders work for you. Forex trading involves risk, but that is the reality for every market. My goal is to introduce you to traders like myself that have already been able to produce positive results on a consistent basis, which will give you a much higher probability to profit. In this video, I'm going to cover information that will help you build a solid understanding about the Forex market. So let's get started. Let's start at the very beginning, which is, what is the word Forex? What is the definition of Forex? Forex is the abbreviation of foreign exchange. There are more than 4,500 banks around the world involved in daily transactions. The ones you see on the screen now are just the top 10. We also have big and small private businesses that make currency exchanges every day. Individuals who trade in this market are considered retail traders. We also have millions of individuals trading on their own. The Forex market is by far the largest and most liquid financial market in the world. What you can see in this image is a side-by-side comparison that will show you the difference in size of liquidity per day in the Forex market and other financial markets in the world. I also wanted to give you guys some of the differences that I say are the major differences between trading in the stock market, which is the most popular financial market in the world, and the Forex market. One of the biggest differences is the hours of operations. As you may already know, the stock market in New York opens between 9:30 a.m. until about 4:30 p.m. Eastern. The Forex market is open 24 hours a day, 5 days a week. For a lot of people, this is a big advantage because not everyone is available to trade during normal business hours. For us traders, it's also a great advantage because it allows us to be able to trade different strategies, different styles at different times. And I'm going to talk about that a little bit more as we go through this video. Also, one of the biggest differences between the stock market and the Forex market is that the Forex market is not a centralized exchange, like for example the New York Stock Exchange. It is an electronic market. Also, the Forex market has superior liquidity, which means it's a lot easier to open and close transactions. As you may already know, in the Forex market we trade currencies. Currencies are traded in pairs. Currency pairs are divided in two categories. We have the major currency pairs, which are the pairs highlighted in red, and we also have exotic, also known as cross currencies, which are the ones highlighted in blue. There is actually a lot more exotic currency pairs like the ones you see here. There is just so many that I didn't have enough space to put them all. Whenever you see a currency pair that involves the US dollar like the ones you see in red, those will be considered major currency pairs. As I mentioned to you earlier, the Forex market is open 24 hours a day, 5 days a week. However, there are 3 main trading sessions throughout the day. The trading day begins with the Asian session that opens at about 7 p.m. Eastern, which is New York time. Then we have the Euro session, which also combines with the London session. And then at about 8 a.m. Eastern, the US session begins. For those of you that are in different time zones, I also included the GMT time in this slide so that you can use it and you can figure out what time this might be for you. This is very basic, but it is very important that you understand it clearly, which is knowing whenever you see a currency pair, whenever you see the price moving up or down, the way that you know which currency is getting stronger, meaning which one is appreciating and which one is depreciating, the way that you know that is the first thing you need to know is that the currency to the left is considered to be the base currency. The currency to the right is considered the cross currency. So for example, when price moves, and let's say the euro US dollar moves from 1.5680 to 1.5700, the currency that would be getting stronger would be the euro. So if you see the price going up, the currency that appreciates would be the currency to the left. Okay? Which at the same time, if one currency goes up in value, that means the other one is going down in value. So in this example, if the price moves up, the euro is getting stronger while the dollar is getting weaker. In this slide, which one would you consider that is getting stronger and which one is getting weaker? If you guessed that the euro was getting stronger, you were correct, and the dollar is getting weaker. Again, if price moves up in the euro US dollar, the euro appreciates and the dollar depreciates. Now, what is a pip? We are actually in the business of accumulating as many pips as possible. That's how we make money. The definition of the word pip is percentage in point. You see, most currency pairs are priced up to 4 decimal places. The smallest change would be the last decimal point, which is the one considered the pip. The value of a pip depends on the size of each transaction. So for example, if I were to open a transaction for 1 mini lot, which is approximately $100 US, each pip would be worth $1. If I were to open a transaction for 1 standard lot, which is approximately an investment of 1,000 US, then each pip would be worth $10. 10 standard lots would be worth $100 per pip. 20 standard lots will be worth $200 per pip. Now you can make pips in 2 ways. You can make pips if the price goes up. For example, in this transaction, I bought the pound US dollar at 1.62944. I closed the transaction at 1.63194 for a profit of 25 pips. You can also make pips when the price goes down. In this example, I sold the euro US dollar at 1.4367 and I closed the transaction at 1.4354 for a total of 13 pips. Again, you can make profits in 2 ways. You can make profits by making pips when the price moves up or when the price moves down. Now, the information I just covered is really the most basic information that you need to know in order to have a better understanding of how the Forex market works. However, I also wanted to cover some information about asset allocation, which in my opinion is probably the most important thing you need to understand. Not just in the Forex market, but in any investment. Traditionally, the way that investors have allocated their money has been by investing a percentage in stocks, another percentage in bonds, money market funds, etc. But in general, this allocation structure has been getting slaughtered, especially during these troubled times. Now, the worst thing about this traditional way of investing is that they don't provide any protection, but also they don't even offer good returns. In my opinion, one of the keys to success in any business is knowing how to delegate responsibilities. Because, unfortunately, when we try to do everything ourselves, we end up messing some things up. For many reasons, I personally believe that there is no better investment than the Forex market. However, if you're interested to also learn how to trade yourself, I recommend using this allocation structure. You see guys, the reality is that if you try to trade your money yourself, you have a 95% chance that you're going to lose. So in my opinion, the safest way to manage your capital would be by having an experienced Forex trader manage the money for you. I'm sure that you would agree that looking for ways to maximize your profit potential is very important. But what is more important is making sure that your deposits are safe. You know, the way that financial markets are today, we cannot afford to lose your deposits to crooked or insolvent banks. Because of this, the banks we work with offer account protection in segregated accounts, which means that when you invest through one of our managed account programs, your funds will always be safe and in your own accounts. Now, I want to thank you all for watching this video. I really hope that I helped you gain a better understanding of the Forex market. If you have any questions, feel free to contact us at rigfx.com. This was Manny Resto, head trader for RigFX.